Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, S&P 500 and the NASDAQ futures pushing higher this morning as investors digest earnings from AI chip giant Nvidia. Shares of NVDA pushing higher after delivering good but not great quarterly numbers on Wednesday. The chip maker at the center of the AI spending boom expects sales to be about $43 billion for the fiscal first quarter. While that number was slightly above street estimates, gross profit margins will be tighter than anticipated as it rushes to roll out that Blackwell product. Meanwhile, shares of Salesforce, CRM, falling this morning after the software giant gave a revenue forecast that fell short of estimates.
Plus, investors processing the latest read on the U.S. economy. U.S. jobless claims rising to the highest level that we've seen since the start of the year amid an increase in job cut announcements. This is coming from both corporations and federal agencies. Also, the second read on GDP data coming in line with estimates, staying at an unrevised 2.3% annualized pace in the fourth quarter. But inflation once again proving to be quite stubborn, with the quarterly read on the Fed's preferred inflation gauge climbing to 2.7%. That was up from 2.5% initially reported.
And traders and officials are digesting the latest tariff news from the White House. The president clarifying tariff remarks today after giving a series of confusing answers about his plans to impose levies. The president said he'll target the European Union with 25% import taxes on their cars and all other things, adding that he'll be announcing it very soon. The president this morning confirmed Mexico and Canada tariffs will go into effect March 4th, and that China will also be charged an additional 10% tariff that same day. Investors digesting the latest news out of Washington and also Nvidia earnings this morning here. Nvidia, as we've got the chart up, let's start there. You're seeing shares pre-market hold on to some of the gains here over the past 2 days. Still just a fractional move higher here, but this is a far cry from that 8.5% move that some of the options contracts were pricing in coming into the start of this. And it really just goes to show how much of a Goldilocks scenario Nvidia really had to navigate itself through, and for some of the margins that investors are anticipating going forward from this juncture.
Yeah, exactly. I think kind of the whipsaw action that we initially saw just in terms of shares initially being under pressure. Now we're looking at gains here. How the open very much just illustrates that Wall Street is very much split on this. I think on the surface, when you take a look at these results, obviously there is a lot to like. There's a lot to be encouraged by. CEO Jensen Huang putting some of those fears that we have seen creep into the market to rest when it comes to any delays surrounding delays surrounding Blackwell, and then also looking ahead to even tariffs or further restrictions here when it comes to curbs here that are expected under the Trump or anticipated to continue to happen under the Trump administration. So I think that very much explains why we are up just about 2%. Of course, gross margins was one of the things that was talked about a lot last night initially when we did see some of that pressure on the stock. And then when it comes to tariffs, I think that's very important here to focus on this morning, because it's the other big driving factor. We're just getting headlines here. President Trump saying Mexico and Canada tariffs going to go into effect on March 4th, but then also China is also going to be charged that additional 10% tariff on March 4th. He also went on to say that April 2nd, the reciprocal tariff date remains in full force. So again, we have started to see obviously investors pay closer and closer attention to this. Yes, they have been able to brush off some of these concerns, but I think it just the ongoing uncertainty coming out of Washington clearly having an impact here on the broader market.
Yeah, and it has a broader implication as well for the Fed policy pathway forward. We've had a range of Fed speakers, Barr kind of kicking off some of the vice chair for supervision, kicking off some of that commentary earlier this week, and getting any inclination right now as to how they're going to continue to react, because that's what it's going to have to be in terms of their data dependency, their reactionary policy decisions that they make, and how swiftly they make them if tariffs do impact their own inflation targets, as they're trying to tamper that down to 2% as their long run goal here. So that particularly is of interest as well for the markets over the course of this week, with the two trading sessions today and tomorrow that we do have left, and the Fed speak that has been going forward but hasn't really been the core central and driving force around the markets the same way it was in years past at this point.
All right, let's talk a little bit about Nvidia, because Nvidia beating fourth quarter expectations, revenue surging 78% from a year ago on strong AI demand. Now the chipmaker also issuing strong guidance for the current quarter. Joining us now, we have Antoine Chkaiban. He is a New Street Research Technology Infrastructure Analyst. Antoine, it's great to have you back here on Yahoo Finance. So we are seeing some gains here ahead of the open. Of course, this comes following the initial drop that we saw on the results yesterday. I'm curious how you're making sense of that knee-jerk reaction maybe that we did see and your assessment of the quarter.
Thanks, Seana. Thanks, Brad, for having me. Great to be back on the show. I would say, our key takeaway here is that Blackwell is ramping very fast. 11 billion sales in the quarter. That's well above our expectations. That's well above what the company guided for last quarter of several billions. And I think that's what the street likes in the print. It means that Hopper revenues are declining overall sequentially. But the most important takeaway here is that it dismisses concerns of a backloaded year. There were a lot of concerns in recent months, in recent quarters, around Blackwell being slow to ramp, around some challenges in ramping the rack level system that's really pushing the boundary of innovation. We're talking about really complex systems here, and I think investors were worried about that. And now you see the company printing 11 billion sales of Blackwell in the quarter. That completely dismisses those concerns, because now we expect in the next quarter probably sales of Blackwell approaching 20 billion revenues. And that's going to more than offset, of course, Hopper coming down. So I would say that's the key takeaway from the quarter here.
And it seems like they're really leaning on these different configurations of Blackwell to drive some of the margins going forward. If we can get real nerdy with it for a second here, what does that configuration set and the broader ecosystem for Blackwell look like here, especially as they're trying to make sure that they can extract more margins to impress investors long term who may not have been impressed on the initial release of the results?
So, as you know, up to now, a GPU system, consisted in 8 GPUs, a GPU server, what Nvidia has been calling, a DGX, an HGX, comprised up to 8 GPUs. And as we're moving to Blackwell, we still have the option to have an 8 GPU server, but now you also have a 36 GPU server. You also have a 72 GPU server. And you can, use different types of networking to connect these 72 GPUs or these 36 GPUs, and you can water cool them, you can air cool them, and so that makes, of course, the ramp of that new generation much harder. And so it's no surprise, that gross margins are coming under pressure, and we expect things to improve throughout the year as the product ramps. But actually, over the longer run, these chips are not getting any less complex. As you think, about Rubin and its successor, we expect a lot more high bandwidth memory, which is this memory where the chip can really exchange data with the memory at very, very fast bandwidth, very, very low latency. We expect more of that in the subsequent generations, and that's going to keep driving gross margins down in our view. That being said, revenues are going to grow so much, and Nvidia is going to be able to extract leverage on OPEX in a way that's still going to drive very, very strong earnings growth. So we're not concerned about any of that.
Antoine, talk to me a little bit more about just the earnings growth that you are expecting in the quarters to come. And I want to play a quick soundbite that we heard from CEO Jensen Huang, Nvidia CEO Jensen Huang last night, talking about Blackwell Ultra and the impact that he sees that having here in the second half.
Blackwell Ultra is second half. As you know, the first Blackwell was, we had a hiccup that probably cost us a couple of months. We're fully recovered, of course. The team did an amazing job recovering, and all of our supply chain partners and just so many people helped us recover at the speed of light. And so now we've successfully ramped production of Blackwell. But that doesn't stop the next train. The next train is on an annual rhythm, and Blackwell Ultra with new networking, new memories, and of course new processors, and all of that is coming online.
Antoine, I bring up that soundbite there in the context of what you were saying earlier, just in terms of the fact that you thought Jensen Huang was able to alleviate some of those concerns surrounding the delays and maybe the impact that is ultimately initially had on Nvidia. How do you see, how strong is Nvidia's pricing power still here in the quarters to come?
So I think the pricing power is going to remain very strong for the foreseeable future. You don't really have much competition out there that can match Nvidia. You have AMD that's like more than an order of magnitude smaller today, and who's struggling to ramp more than like its two very large customers, Microsoft and Meta. And then you have ASICs, you have in-house ASICs, and so far you only have one hyperscaler who's successfully ramped, like the TPU, and I'm talking about Google, of course. They've been working on that project for 10 years, and it's no easy task. It's not only like designing the chip, it's also designing all the software on top of that to make a good use of that chip. It's also making a chip that's flexible enough so that it can adapt to all this change, in the workload. That's like all these AI models introduce new technologies from one generation to the next. Now we're talking, about 3 scaling laws. You have like a reinforcement learning that comes into play. All this variation is easily handled by GPUs. It's much harder, when you have like a chip that's more dedicated. And so bottom line is that there isn't that much competition today. And so we expect NVIDIA's pricing power to remain very strong. And if the gross margins come down, it's simply reflecting, first in the near term, of course, the Blackwell ramp, and over the longer run, as I mentioned, like increasing content of memory inside these chips, but nothing to worry about.
Antoine, we only got about 15 seconds. Even with the move here that we're seeing pre-market, Nvidia will still be down year-to-date scale here. For investors trying to figure out before the opening bell and going into the start of today's trading activity, if it's an investable company at this level on that pullback, what would you tell them?
I would just tell them that we're moving, so 2025, I think is fairly well framed, We have sequential growth that's going to be like in the mid-teens. We expect 200 billion data center revenues for the year. That's consistent with the supply chain on one side. That's consistent with hyperscale capex on the other side. All the hyperscalers have raised capex significantly, and now we have like a consistent view of 25. I think the debate is shifting to 2026. And in 2026, you're going to have a handful of players who are going to move from clusters of hundreds of thousands of chips to maybe 500,000, on a trajectory to 1 million by 2027.
Right.
That's enough to drive all the growth that is going to, be enough for Nvidia to approach, $6 of EPS, and on today's stock price, I think is pretty cheap when you look at it in that perspective.
Antoine, thanks so much for taking the time here with us reacting to Nvidia earnings.
Thanks for having me.
Salesforce issuing a disappointing outlook for the year as its new AI product, dubbed Agentforce, is expected to make only a modest contribution to revenue. Yahoo Finance executive editor Brian Sozzi joins us now with more from his interview with Salesforce CEO Mark Benioff. What did you find?
All right, thanks so much, Brad. Yeah, that is why Salesforce shares are under pressure. On the earnings call, you heard the company talk back the revenue contribution this year from Agentforce. Keep in mind, Salesforce shares ran about 16% higher into this quarter over the past few months, in large part because of that Agentforce optimism. So I asked Mark Benioff, Mark, why did you talk this down? Here's what he said.
Well, of course, we're running a deferred revenue model, and so it takes a while for the revenue to build up. And also, the level of scale that we're delivering, Brian, is incredible. We're not a small company. We're now, as you can see, there's only Microsoft and Oracle have ever delivered revenue above 40 billion. So we're in rarefied air. So it will take a while then for Data Cloud and Agentforce to get up there.
And what I think you're seeing, at least with the notes and the analyst reaction, at least here this morning, and I did a roundup of all these notes on the Yahoo Finance homepage. You can find that there. But some price target cuts on Salesforce after these results. Mostly the street is sticking with Salesforce from either an overweight or buy rating perspective. The thing is, and I tried to put this here on our investor checklist, of course, Agentforce opportunity talked down for this year. It looks like the street is more bullish on this being a larger revenue contribution to Salesforce next year. Now, you can't write off the next 4 quarters or 3 quarters for Salesforce, so they're going to have to deliver on Agentforce, but at least right now the stock could stay in the penalties box, and especially considering where the valuation is following that pre-earnings run-up.
And so it's also just the executive shakeups too, right? That's something that investors are watching too, just in terms of the incoming.
Yeah, that's a good point. So for the first time, Salesforce has combined the CFO and COO role. It's something I'm starting to see other companies do. I mean, it makes a lot of sense. CFO, COO, there's a lot of overlap there in those positions. I think that is in part why you're seeing some of that cautious EPS guidance on Salesforce. It gives the new CFO some air cover, is what I'm hearing, to come out there and build some even more credibility with the street, come out, perhaps beat for the next few quarters, and come out and beat that guidance. So I can't say I'm surprised from that perspective. Anytime you change a CFO, usually guidance could come in below estimates. You have to give that CFO some time to learn the financial statements and come out and put a plan forward of their own.
Certainly, Ariel Saz, great interview. You can check out Sozzi's full interview with Mark Benioff on yahoofinance.com. All right, well, President Donald Trump isn't slowing down on tariff policy. This morning, announcing an additional potential 10% tariff on China that's set to go into effect on March 4th, and that's along the delayed 25% tariffs on Canada and Mexico. Now, this coming after Trump threatened to impose tariffs on the European Union yesterday. Let's take a listen.
It'll be 25%. Generally speaking, and that'll be on cars and all other things. And European Union is a different case than Canada, different kind of case. They've really taken advantage of us in a different way.
Joining us now to break it all down is our very own Rick Newman. And Rick, I'm curious how you're looking at this, just in terms of how likely they are. I guess it's anyone's guess at this point, and how long we're going to be dealing with these types of threats coming out of Washington.
Oh, I think we're going to be dealing with these types of threats for the duration of Trump's presidency. I don't foresee a time when he's going to be ever completely satisfied with the way we do global trade. Everybody's trying to figure out what to make of this. I mean, the obvious question is how much is bluster and threat and how much is reality? And to some extent, Trump seems to be making it up as he goes along. As part of trying to understand where this all might be going, I went back and looked at the whole timeline for Trump's trade war during his first presidential term, and that was mostly in 2018 and 2019, leading right before COVID. And one unmistakable pattern there is there's a lot of threatening tariffs, and then there's a lot of pulling back on tariffs. So some of them tend to go in place, but not all of them. And I think that's what we're looking at here. So just for some perspective, I mean, Trump originally, when he was running for president last year, he said he wanted to put a 60% tariff on Chinese imports. And then the first thing he did was, well, he did put tariffs on Chinese imports, but it was only 10%. And now he's threatening another 10%. And I think what he's indicating is that he's not getting the results that he wants from the first threat of tariffs or the actual imposition, which is a decline in the fentanyl shipments. So he's going to keep raising the pressure until he feels like he gets what he wants. Most analysts think that the threats on Canada and Mexico, those would really hit our economy hard, much more than the 10% on China, that he's not going to do that, but that he wants something in exchange. But, I mean, everybody who's following this is just guessing, and I don't think Trump himself actually knows.
Yeah, it's sounding more and more like other countries are coming to the realization that the president might want more of the optics of a deal being made, and then the details will be sparse going into it, and we'll see what we get coming out of it as well. Rick, we got to leave things there. We know you'll continue to track this for us. Coming up on Morning Brief, everyone, we count you down to the opening bell on Wall Street. Plus, for earnings coverage ahead from Snowflake to Paramount and more. And we sit down with the CEO of Nutanix to break down their latest results. We've got all that and much more on Morning Brief. Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's get a blast from the past up in here to start things off. Shares of eBay trading lower this morning after the company issued sales guidance that came in lower than analysts expected. The CEO of the online resale platform attributed the slowdown in sales to softer demand in Europe. Shares right now are lower by about 8% here and continuing to keep a close tab on shares of eBay as we've been tracking them even over the past 52 weeks. It still has been a broader climb higher that we've been tracking here, even despite this little bit of a pullback here. The shares over the past 52 weeks up 55%. It's been interesting to watch.
Yeah, certainly. They talk about the fact that tariffs adding some of that uncertainty that's influencing consumer purchases as well as sticky inflation. One of the trends that they've noticed there at eBay is just the uptick that we've seen in refurbished products and the fact that they are a little bit cheaper, obviously, when you compare it to some of the new products that are being offered right now. That actually accounts up to 40% of the value of the merchandise sold on the platform. So they are seeing steady growth there. It's something that the CEO noted within this release, and looking ahead, it's one of the trends that maybe are expected as we continue to see, obviously, sticky inflation. That was something that was brought up in the GDP report this morning, and then also the more uncertainty coming out of Washington here over the last hour or so, just in terms of some of the plans here for tariffs and the ultimate impact that could have on prices going forward. So again, consumers are faced with a tough choice. Many of them here turning to eBay. One of the reasons that we're seeing some uptick here in the refurbished products category.
What's the last thing you bought on eBay?
I don't think I've ever bought anything.
Really?
No.
Come on now. No. Even for nostalgia's sake. Yeah, tweet at us, whatever the
what was yours?
You bought on eBay. Probably a basketball card, honestly.
Oh, really?
Yeah, I used to be a big collector back in the day. Yeah, we'll talk about it all.
Did you get a good deal on it?
Who knows? I think so.
All right, let's talk Paramount. Paramount Global lower pre-market after the company missed on sales profit estimates in the latest quarter. Revenue for the company's cable TV segment that fell on a year-over-year basis despite streaming service Paramount Plus adding its highest number of subscribers that we've seen in 2 years, nearly doubling analyst expectations. The company also reportedly pulling back on some DEI initiatives as well. When you take a look at the stock reaction here, off just about 1.5%, you can really see that the focus here, at least from the street, is on the weakness coming out of the TV side of the business, and the fact that that was not solid enough and brought up enough concerns here to overshadowing some of the strength that we've seen in streaming and in movies business. Of course, cost is a big concern here for the street going forward, just in terms of how much is being spent, what is necessary in order to pull back to offset some of the weakness within the TV category. And at least when you take a look initially at the street's reaction, they think that there's a long way to go.
Yes, there is. Total company revenue, that did grow 5% for Q4, not impressing investors there. Paramount Plus, that increased revenue by 16% for the fourth quarter and 33% for the full year, the fiscal year here. And as you think about how all of the companies are kind of using Netflix as their North Star to try and extract even more value in the average revenue per user that they're seeing here, these percentages are kind of far off of what Netflix has been able to have even activist investors call out for some of the names out there in the entertainment, direct-to-consumer entertainment landscape, even like Disney, when there were activist pressures and campaigns there here. So you got to wonder for Paramount in their own ambitions here, how that's going to translate in that long term, in the ramp, especially as, you know, I think out to some of the Deloitte digital media surveys that talk about the number of subscription services that families, that companies, households, not companies, I guess your household is a company if you want to look at it that way. But as you're thinking about the number of subscribers or subscriptions that households are comfortable having right now, that used to be at 3 or 4. Now with all of these price hikes, that's seemingly continued to deteriorate to be 2, maybe 3. Maybe you're borrowing a friend or a family member's subscription and password, and then we've seen the crackdown on password sharing too. So it's going to be a long road ahead, as you mentioned, for Paramount, and a larger question of what type of value extraction they're able to get from the paying customers on the platform.
Yeah, I think the combination with Skydance very much, it comes down to execution.
Yeah.
In terms of what that looks like, the timeline of that. There's certainly a lot to like in this report and be encouraged about, especially when you take a look at the progress here when it comes to streaming, the solid subscriber gains that the company did have during the quarter while narrowing its losses. So again, there are a lot of things to like here within this report, but I think the overall weakness on the TV side at least outweighing some of that for now.
Yeah, 5.6 million new subscribers on Paramount Plus. That was their best quarter ever. Finally here, let's talk about shares of Snowflake. They are on pace for their best day in 3 months on enthusiasm for its better than expected sales forecast and increased AI offerings. Snowflake expects product revenue to jump by 24% in the current fiscal year here. The company also announcing it will offer its customers direct access to OpenAI through its platform, building on a similar partnership with Anthropic announced last year. Shares of Snowflake, they are jumping by about 13% here pre-market, not too shabby.
Not too shabby. I mean, these numbers are strong. You're taking a look at the strong fourth quarter results. Product revenue was up 28% from just a year ago. You mentioned the fact that the company guided here to fiscal 2026 product growth. That was actually of 24%, which is just above the street's expectations. So they did deliver on the strong results here for the most recent quarter. Taking a look at the guidance, the outlook obviously very bullish. That's why we're seeing the size of the reaction here in the share price here this morning. I think the question is whether or not some of that momentum can continue, given the fact that that revenue growth is beginning to stabilize here in the mid 20%. Whether or not they can continue to do that, expand margins, is a big question here from the street.
Yeah, that got brought up on the call too here, especially thinking about the growth in this environment. And one of the analysts here had brought up on the call, the software companies right now, there are not many of them that are actually growing at scale and growing 30% in this environment. And one of the huge things that this comes back to is both the existing customers that a company like Snowflake has, but the net new customers that they're also bringing on board. And if you think about those existing customers and how they're selling further into that base, renewing and renewals among those customers are going to be core. The company talked about that and fully expecting that many of those existing customers would sign new commitments to really kind of lock in that baseline rate.
All right, well, keep it right here on Yahoo Finance. We are just getting started. Opening bell coming up next.
There you're taking a look at the opening bell at the NASDAQ and on Wall Street at the New York Stock Exchange. You've got Aitco ringing the opening bell. Yeah, press it, young fella. There we go. He pressed the button, he got some funfetti. And then you've got Primo Brands ringing the opening bell at the NYSE. If you've had water, you've probably had a Primo brand, honestly. Parent company of Saratoga, companies like Poland Spring underneath of its belt as well, plus about a dozen plus maybe 24 others as well. All right, taking a look at how we kick off today's trading activity. The Dow Jones Industrial Average, you're seeing things start off the day higher by about 0.1%. We'd love to give you some context here, so I'll put this on a 2-day view here for you. And ultimately, over the past 2 days, still net lower by about 0.3%. Let's give you a 4-day and show you what's transpired this week. And that's where you see some of that waffling taking place here over the course of this trading week. Also, the NASDAQ composite, you're seeing that open up higher here by about 0.75%. Past 4 days, not great. It's down by about 1.5%. We'll see what we can do about that today. S&P 500, you're seeing that to the upside by about 0.5% to start off today's trading activity. However, over the past 4 days, 4 sessions, lower by about 0.5% at this juncture. Let's take a look, since we mentioned the S&P 500, at the 11 sectors of the S&P 500 to kick off today's trading activity. Looks like you've got more advancers than decliners right now. 6 in the green to the 5 in the red as of this juncture. Utilities pulling up the caboose right now. That starts off the day down by about 0.7%. We'll round that off too. However, communication services, wow, up by 0.9%. And since we're talking about some of the heat map activity, let's go on over to the NASDAQ 100 heat map, where we've got to look at Nvidia just to see how things kick off on this trading day. After those earnings that came out yesterday after the closing bell, we begin today's trading activity higher by about 1.2%. But let's give you the broader context here. Year to date, it is still ultimately lower despite this move higher to start off today's trading activity. And if you've seen some of the volatility that has transpired in one of the earnings bellwethers that is out there for the semiconductor, the AI trade, and more broadly, all trades for the past year and change here. For more, let's get on over to Yahoo Finance's Jared Blickery for a look at what's moving here early in today's tape. Jared?
Well, thank you, Brad. Thought we'd take a look at the month that almost was with the NASDAQ composite, because it is down 1.5% in these 4 days. But let me put the 18-day total here, down 2.07%. That's bad enough to actually make it the worst month since April of 24. So that's last year, almost 1 year. But still, not that bad. And if you take a look at the NASDAQ 100, I think it's instructive that is down not even 1%. So the larger cap-oriented NASDAQ 100 also down, but not quite as much, and not with that comp that we were looking at with the composite. Just going to take a quick look at the 10-year T-note yield. That is up 4 basis points today. And the U.S. dollar index also jumping, but nothing to write home about. So we're going to move on to the sector action. And much like our last analysis, I just want to point out, first of all, actually, that consumer discretionary, one of the leaders today, as Staples is one of the biggest laggards. And that's kind of how the month has gone. Here we're going to do a month to date over these 18 trading days. We're in the 18th right now. Staples, that's XLP, that is in the forefront. And consumer discretionary, that is an Amazon and Tesla story, that is pulling up the rear there. That's down 6.6%. Moving on, let's take a look at the Mag 7 real quick. As Brad was just noting, only Apple of the Mag 7 is down, and that's just by a smidge, about 12 basis points there. Nvidia up about 0.6% after that much anticipated earnings report there. And there, Apple just turned green. So what do you know? Want to focus on ARK for a second. The ARK Innovation Fund, and that's the ETF that houses all this, actually having its worst month since April of 2024 last year. And you'll remember that is also the stat that we had for the NASDAQ. Here is month to date, and you can see Tesla, the biggest weight there, down 27%. Coinbase also down 24%. And if I got a little time here, going to tell you real quickly that in futures, WTI crude oil is jumping the most in 6 weeks, but I want to get to Bitcoin. I'm going to leave on that. We touched 82,000 overnight or yesterday, and we are bouncing up. But Bitcoin itself on track for its worst month since November of 2022. That wasn't the best year for crypto, but that was close to a bottom. So we'll see what happens with crypto here today. Seana?
All right, we'll be watching. Jared, thanks so much. It's time now for today's strategy session. The S&P 500 has been stuck in a narrow trading range, with the benchmark index not entering oversold or overbought territory since July. However, our next guest warning of a potential 10% correction looming. We want to bring in Barry Bannister, Stifel Chief Equity Strategist. Barry, it's great to see you. We are looking at Nvidia offering maybe some relief to the markets here this morning, but it doesn't sound like you think it's going to last. Why?
Well, the market lives for easy interest rates. We do think the Fed will cut to 4.0% mid-year, but there could be a hawkish hold. In other words, with inflation stuck closer to 2.75% on what's called the core PCE deflator, the number that the Fed watches very closely, it's very hard to justify too many cuts. I mean, if you look at the real interest rate, the rate after inflation, the middle value, the median, the last 50 years, short-term money should give you 1.21%. And so if you're looking at about 2.75 to 2.8, add 1.21%, you see how the Fed really can't go below 4. So as we get through the year, I think the Fed will probably take back or react slowly to a slowing economy, that second rate cut.
What are the top factors that you think would drive that activity from the Fed?
Well, the stickiness of inflation and the economy decelerating then brings the question of what is the Fed's reaction. It's called the reaction function. I think the Fed will be a little slower. Stagflation, even mild stagflation, which is a little more stagnant economy and sticky inflation, could cause a pullback in the consumers. They'll decelerate from the recent 4% spending rate. And jobs are becoming a little harder to find. And they have spent themselves up quite a bit. We wouldn't be surprised to see the consumers pull back. You're not going to get anything from government or net exports with the strong dollar. So the GDP numbers will really fall off as you get into the back half of the year. And again, the Fed's reaction to that, with inflation still very sticky, is going to be the tell.
Barry, I'm curious how you're looking at the moves that we've seen in the bond market. You have the 10-year yield right around 4.3, substantially lower than that 4.5 range that we were trading around now for quite some time. What does that signal to you, just in terms of what is being priced in, and ultimately how this will likely play out for equities?
Okay, let's say like I said, the appropriate short-term rate is about 4. Now they can go easier than that, and we have had, Jay Powell has been, believe it or not, one of the more easy Fed chairs of the last 3. I mean, Greenspan in the back half of the 90s in the tech bubble had a much higher real interest rate, or a rate after inflation, and Bernanke in 2005, 6 into 7 actually got to a much higher real interest rate. So Powell is an easy peasy chair, no question in my mind. And when you had the long end, so you've got the short end around 4 is a fair value. The long end was 4.8. Markets felt that. They went sideways. It pulled back to 4.3. That 50 basis point drop in the 10-year yield has really been keeping us from dropping. And the question then becomes, economy decelerates, inflation sticky, what's the Fed going to do? How does the bond market react? And this is all going to play out over the year.
And so then on the equity side of the trade, what is the defensive play that investors could orchestrate with their portfolio right now?
Well, ever since the Nvidia quarter 2 years ago, everyone's been on the AI trade. And I understand, keeping a position, even I do, keep a position barbelled into tech to benefit from the mania that we're in. But you're at a very, very high multiple of earnings. Your more sophisticated valuation methods like enterprise value based against economic profit or return on capital above cost of capital, they also indicate very much like the late 1990s, a level of enthusiasm among investors that it's dangerous. So what you do is you barbell that, or you are defensive against that with things like healthcare, staples, utilities, which are not doing well today. So you buy on the dip.
And so if you are dip buying, are those the top dip buying opportunities, those that are on the defensive barbell or side of the barbell? Or is it some of the riskier assets that might also be seeing a significant pullback here and have already kind of run high on valuation?
Well, like I said, the first 6, maybe 9 months of the year will probably end up being in a trading range. And it has been year to date a trading range. But then you'll have a sharp fallback, particularly your late third, early fourth quarter, typical almost seasonal weakness in the stock market. So it could be just a very wobbly year with a pullback in the market that would benefit defensives because they would hold their value. Their price earnings multiples, by and large, are not as bad, and their earnings are decent. So in a sense, they would just be defense against a more offensive strategy that is really fully valued here.
All right, Barry, always great to talk to you. Thanks so much for joining us here this morning. Barry Bannister of Stifel. It's time now for our chart of the day. Let's send it over to Madison Mills for a closer look at stock picking. Maddie.
That's right, Seana. Stock picking is so back this year. If you take a look at actively managed funds, you can see that nearly half of them have outperformed funds that just track the S&P 500 year to date. And if you take a look historically, that's not necessarily the case, right? We always say that, especially for retail investors that don't necessarily have a lot of great hygiene, you're in luck because it's actually really hard to outperform the S&P 500. If you look at the past decade, you can see here behind me that actively managed funds have struggled to outperform the S&P. It's usually typically about 10% of them that can eke out gains better than the S&P 500. So what does this tell us? Well, this is another example of those mega cap tech names not being the performers that they once were and that we've grown accustomed to, especially over the last 2 years. That Magnificent 7 ETF is still in correction territory, and that is good news for these active managers who are looking to have an edge on the market, and therefore they are not necessarily invested in a market cap weighted structure like the S&P 500. So again, this does present opportunity for active managers who on average do tend to struggle to outperform those major averages here. It's all about kind of finding which companies now can sustain earnings momentum, especially as more broadly within those tech names, we're seeing earnings moving sideways just a bit here. So we're going to continue to talk with investors. And I think hopefully this leads to more interesting conversations with them about how they are navigating this tricky environment and finding opportunities for that earnings momentum when you can't just rely on the big tech names.
Maddie, thanks so much. Appreciate it. Coming up, everyone, a beat and raise quarter for software infrastructure company Nutanix. We'll discuss the latest results with the CEO. You see him there waving. Rajiv, we'll get to you in a second.
Shares of Nutanix, the infrastructure software company, moving today on the heels of its results. You're looking at gains right now of nearly 10%. The company boosted its revenue guidance for the full year after beating the street's adjusted earnings expectations for its fiscal second quarter. We want to bring in Rajiv Ramaswamy. He's CEO of Nutanix, joining us now. Rajiv, it's great to have you back here on Yahoo Finance. Talk to us about the quarter. Clearly, you are seeing a lot of momentum that's reflected in the guidance, just in terms of some of that carried over momentum that you're expected to see in the quarters to come. Talk to us about the biggest driving factor here of that.
Seana, great to be with you all today. Three factors are driving our results and our guide as well. The first is that companies and organizations around the world are choosing Nutanix because we deliver a platform that can help them run all their modern applications in a very efficient way, while also enabling them to do things in the future with AI, generative AI, and other new workloads that might come up. The second is that there's a number of customers and organizations around the world looking to reduce their dependence on one of our competitors, VMware, now owned by Broadcom. And Nutanix is the best platform and the easiest platform for them to migrate those VMware applications over. The third is we've been working on our go-to-market efforts for quite a while now, and we're seeing the fruition of some of that now across our customers, across our partners, across our own sales go-to-market engine. And we're seeing some increased contribution from some of our OEM strategic partners as well. So all of this has contributed to these results that you saw in Q2 for us, and also contributed to our ability to raise the guide for the full fiscal year.
For B2B companies, Rajiv, for a few of the past quarters, we've heard about these elongated deal cycles. Where does that stand right now as you've been working with both net new customers and existing customers and trying to drive renewals there?
Yes, and Brad, that's a great one. I mean, we've been talking for several quarters about this as well. The fact is that deal cycles have been somewhat elongated. They need more approvals. People are more careful about making sure they get the return on whatever investments they're making. And again, as a platform, we deliver significant total cost of ownership benefits. Now, you can see the results of some of this coming. Our new logo count has been growing up about 50% year over year, this quarter as well as in the past quarter. So we continue to see more and more customers embracing our platform. And that's, again, a testimony to the fact that we are able to deliver those benefits to them.
Rajiv, are you seeing any signs of tighter budgets there from your customers?
Well, the macro piece of this has continued to remain fairly stable. It's still uncertain, it's dynamic, lots of potential changes, but we've seen a fair amount of stability. There's still a lot of scrutiny into what they spend their money on, but we feel good about the pipeline that we have in front of us, and that's really what has enabled us to raise our guide for the full year, despite what's going on around us.
What are you seeing in cybersecurity as a driver for some of the discussions that you're having with potential customers or existing customers, and how that's also flowing through to the deals that you are seeing come through?
Yeah, I think security is an integral part of what is top of mind for almost every customer. For example, I mean, when we look at our product, we provide things like ransomware protection that's built into our platform. We provide strong encryption. So security is an integral factor as they consider any of these enterprise class platforms. Companies are running their business critical applications on a platform like ours, and they want to make sure things are secure. And we have a number of capabilities in there to help them with that. And also potentially simplify their security posture and make them be able to be more defensive against attackers.
When you talk to me a little bit more, Rajiv, because what you're saying about the macroeconomic backdrop is very interesting. And I'm curious just in terms of how that's influencing or impacting how you navigate your strategy here in the coming quarters. And also just a sense from a business leader of some of that uncertainty coming out of Washington. How are you then unpacking that and trying to figure out the best path forward?
Yeah, I think, again, this is a very dynamic environment. Things are changing every day. And we don't control a lot of that, but we have to adapt to what's going on. There are a number of factors in there. There's talks of tariffs, and we as a software company are a step removed from that. But we try and provide, for example, a lot of flexibility to our customers to be able to run on a variety of different hardware. And our hardware partners, for example, are doing everything they can to diversify their supply chain and be able to manage potential impact of tariffs. But we are a step removed from there. We do business around the world, and we continue to serve those customers around the world, Europe, for example. But net, I would say we are focused on what we can control, and we will adapt to whatever new policies come up and adapt to that. Again, I think we still feel good about the outlook despite what's going on in the macro, given the factors that we've talked about earlier. And that's why we're raising our guide.
Just as a follow-up to that, I guess the kind of consideration, and I think this came up on the call too, with regard to government spending that we're seeing at this juncture. And I think you have some government partners that you work with as well. Are you seeing any contraction in the propensity to spend from them, knowing that there are these cost-cutting measures that are being rolled out?
And that's an interesting dynamic. I'll say, first of all, that the US federal government over the last 3 years has represented at most 10% of our overall revenue. So our exposure is a bit contained there. But that said, we work with a lot of arms of the federal government across defense, civilian, intel, et cetera. And our pipeline is good, right? And interestingly, I mean, we don't know how much of that will be impacted by what's going on here, but also our technology can be a key enabler to make government organizations more productive, more efficient. So in some ways, I mean, as organizations will invest in technology to make them more efficient as well. So there's puts and takes on this, and we factored this in as we provided our increased guide that you're seeing there.
Rajiv, always a pleasure to grab some time with you. Thanks so much for breaking down the most recent results.
Thank you, Brad. Glad to be with you.
We've got all your markets action straight ahead. Stay tuned. You're watching The Morning Brief. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. First up, British energy giant BP reportedly under pressure increasing right now from activist investor and Elliott Management around its turnaround plans here. BP announcing Wednesday it will turn focus back to its core oil and gas business while lowering spending on renewables. According to a Bloomberg report, Elliott sees the plan as lacking in urgency and ambition and thinks it didn't go far enough. Bloomberg reports Elliott has a nearly 5% stake in the energy company.
Plus, Nissan Motor is making plans to replace its CEO. That's according to a report out from Bloomberg. Now, the company's directors are gauging interest in potential candidates to replace the CEO, who has been with the company for 22 years and CEO since late 2019. Now, this comes after the Japanese automaker cut its full-year outlook for the third time, and merger talks with the rival Honda have collapsed. Now, Nissan has struggled to boost demand for its vehicles, relying on promotions to keep control of its inventory.
Finally, Norwegian Cruise Line is signaling strong cruise demand this year, even as its profit outlook missed estimates. They see full-year adjusted earnings per share at $2.05 versus the projection for $2.09. But the cruise line says their outlook establishes a clear path towards their 2026 targets. Norwegian says they remain at their optimal booked position for the next year. The company also beating profit expectations in the fourth quarter. Shares, though, down 5.5%.
All right, well, that does it for a Morning Brief. We keep it right here. Catalyst is coming up next.